Hello, welcome to this session on credit ratings, a part of credit risk management module. My name is Shailendra Marathi. In this session, we'll look at credit ratings, external ratings as well as internal ratings. When it comes to a firm or a business, there are two types of ratings that exist. One is there's an external rating conducted by an external credit rating agency, and then the firms or the banks might conduct their own internal rating when it comes to dealing with the others in the market. When it comes to the individual, of course, there is only external credit rating. When we talk about external credit rating, there are rating agencies which are accredited or recognized by the regulators. For example, in India, SEBI or the Securities and Exchange Board of India is the regulator for credit rating agencies, and they recognize the agency. Globally, there are three big rating agencies: Standard and Poor's or S&P, Moody's or Moody's Rating Services, and Fitch. So all these three are US rating agencies, and they are sort of global in nature. And we have Indian rating agencies, for example, CRISIL, right? Credit Rating Information Services has been there for quite some time. There's CARE and there are other rating agencies in India as well, approximately 7 in number. And then the banks might conduct the ratings for their own customers or borrowers who approach them, and also they review the ratings from time to time. And the rating methodology differs from banks to banks because they can design their own rating methodology. Whereas all these rating agencies, whether global or Indian, they have a credit rating method that they try to follow for all the customers falling within that particular bracket. These are the credit ratings agencies which have been till recently recognized by Securities and Exchange Board of India. So CRISIL is one of the leading rating agencies in India with predominant market share, I think in excess of 60% of the market share of entire rating business in India. TransUnion CIBIL, in which in CRISIL, S&P has a stake, right? Standards and Poor's. As you can see, Fitch has a stake in India Ratings and Research or INRA, and Moody's has a stake in ICRA, right? So these three global rating agencies acquired a stake in Indian rating agencies some time back, right? So they are in the Indian market as well. CIBIL, which is Credit Information Bureau India Limited, is acquired by TransUnion, another global rating agency. There's SMERA also, SMERA, SME Rating Agency of India Limited. Until recently, there was another rating agency called Brickworks, whose rating license has been revoked by SEBI just sometime back in 2022 because they failed to comply with some of the SEBI norms. The external rating agencies have their own way of rating, right? So they have a methodology which they many times publish very clearly on their website as well, as a matter of information to the public and also for the potential customers, right? The companies being rated, they choose which agency to go to, so they become customers for these rating agencies. So there are some defects, when we look at these external rating agencies as highly credible because they have image in the market, they are independent, right? And they have a professional expertise. But some limitations we need to keep in mind. If we look at, let's say AAA rating or AA rating is awarded by rating agencies, we should not, just blindly follow that. Because those ratings are done at the time of debt issues by the companies, right, who are borrowing money from the market. So let's say a company is issuing the debt in 2022 or let's say January, right? In that month, at that point in time, the assessment is done. So it is not necessary that it is valid in, let's say, October of 2022. And the rating pertains to the quality of a particular debt issue, right? Let's say company has come out with 200 crores commercial papers issue, right? So they have placed 200 crores commercial paper in the market, and the rating is specific to that specific debt instrument. It may not be valid after 6 months, if company is issuing, let's say, long-term bonds. The SEC in US, Securities and Exchange Commission, which is a sort of SEBI equivalent in US, they prescribe certain minimum conditions to qualify for debt issues, right? So for example, in India, the CPs have to be rated and they have to be of a particular rating, right? Also, the CPs, commercial papers, have to be a part of overall working capital requirement of the entity as sanctioned by one of the banks. So there are certain, sort of conditions as well. But fundamental problem with external rating agencies is that there is a conflict of interest. The companies choose, whom to approach for rating. So they can go to CRISIL, CARE, for example, globally they can go to S&P, Fitch, right? So obviously there's a conflict of interest because then they become clients for these rating agencies and they are paying them, correct? Just like in case of a company audit, right? The companies appoint the auditors. So if auditor, let's say, is not in the good books of a company, then company will probably remove them. and then the auditors lose the business, right? So similarly, if the rating agency is very strict with the companies they are rating, then there may be a fear of them losing that business, right? So that is an inherent conflict of interest that exists in this kind of situation. And critics have pointed out that this conflict of interest is very important. If you look at global financial crisis of 2008, lot of the instruments like the collateralized debt obligations, the mortgage-backed securities, the CDS credit default swaps, etc., they were rated very high by the rating agencies like Standard and Poor's and Fitch, etc. But they, overnight those companies, etc., became bankrupt. Right? Those instruments had zero value in the market, and then lot of criticism of rating agencies happened at that time in the US. In India also sometimes the companies have failed, soon after the ratings have companies have been going through rating, right? So you have to be a little bit careful when you just, rather than blindly accepting the ratings that are given by the external rating agencies like this. And it's not to suggest that they don't have any methodology or something like that. You just need to take your own care. For example, if a bank is giving borrowing to, so they do their own, they have their own rating mechanism in addition to looking at the ratings given by the external rating agency. Now, on the business credit rating side, I'll just quickly show you how CRISIL does that. So let's look at this understanding ratings on the CRISIL's website. Right? Let's look at that. Just go to this link. For example, go to CRISIL's website once, spend some time there to understand. They are explaining very clearly what all different things they do, right? So they cover corporate sector, financial sector, they cover structured finance instruments, etc. They have solutions specific to the small medium enterprises, their economy, industry, etc. Research for India. They're an Indian rating agency first, and they also service a lot of global clients now, right? Because there's a Standards and Poor's stake in them. So fundamental research, they conduct, sort of design risk models using which banks and other players can, assess risk. Then they look at, integrated view of risk management, etc. Right? On top of it, now that over decades they have got a lot of data, right? So using that data, they are giving analytic solutions and many other things, right? On top of that, so they have created their own customer insights, risk solutions, and so on and so forth. Here they have explained, rating criteria, methodology, all those things are very clearly, explained over here. And you can go to a specific sector, like you can look at power sector, for example, materials, industrial, healthcare, financial, right? And then you can look at what kind of the criteria and the methodology they are following for a particular sector, because every sector has its own performance drivers, right? That you need to take into account when you are assessing the performance of that any company in that particular sector. For example, the NII, net interest income, or NIM, LCR, liquidity coverage ratio, or NSFR, net stable funding ratio, NPA. These are some of the key ratios or some of the key parameters or performance drivers to look at if you are looking at assessment of a bank. And then a lot of this information go through this. How do companies approach them? They want to get rated, rating list, scales. What are the different scales, and so on and so forth. Right. So do go through this website once. Right. So one more link that I will like you to sort of look at is go to again CRISIL's website and look at what is exactly an independent credit evaluation, right? How CRISIL can help the companies conduct that, right? So those kind of things also please do look at here. How do they do that, and then also how what is the rating scale that they follow, right? So these kind of things, good information is available on the CRISIL website and also on some of the other websites. So what does, for example, a particular symbol mean, right? So RP1, what does it indicate, so on and so forth, right? Like that, they have these symbols like AAA, etc., which are given for long-term debt, right? So they have explained what those symbols specifically mean. So I'll urge you to go through this in order to understand more. But fundamentally, they have their own methodology and they assign ratings, and which mean they have a particular meaning behind that. SEBI has taken up the task of making sure that all these rates, they were having different symbols. For example, somebody was having AAA, somebody was having A1 or something like that. So they are trying to make sure that everybody follows the same symbols and the people are not confused. Those are looking at the rating. On the individual rating side, CIBIL, Credit Information Bureau of India Limited, rates almost all of us, right? As soon as you get into a certain age, you start using, let's say, mobile phones, start paying electricity bills, you have Aadhaar, PAN, and you start, let's say, paying your, you take some loan or start getting salary, right? A lot of data flows to CIBIL from banks and other financial players. So they are obliged to report that data under RBI mandate, right, to CIBIL. And then CIBIL takes all this data and assigns creates a, they have their own rating model and they assign a credit rating to us, right? So you might be surprised, you might think, I'm not sort of, I've never approached CIBIL for anything, right? So sorry, I have to go to the next slide. I never approached CIBIL for anything. Why are they having my data, right? But the banks etc. have to report data to CIBIL. So let's look at if you go to this frequently asked questions on their website, on CIBIL's website, you'll get a lot of answers to all these questions. What is the CIBIL score? What factors affect the CIBIL score, right? So there's a video also nicely explaining this. So how, for example, your credit score might come down, right? So they are given, and how can you improve your credit score? What are good practices or what good behavior you can do to improve that? Always pay your dues on time, keep your balances low, maintain healthy credit mix, right? So those kind of guidelines also they are given. In case you find that you can go and download your own report from CIBIL's website. I think once in a year the report you can download for free. Yes, you have to pay a few hundred rupees for getting that. If there's a mistake in the report, you find your rating is bad and it is shown that, for example, you have not availed loan from particular, let's say, bank or NBFC, but it is reported there by mistake, right? You can go and get that rectified by approaching CIBIL. So that process etc. is outlined over here. And the understanding, how to read that particular CIBIL report. I think you can download your report and encourage you to do that. It's available for free once in a year to you, right? So go and look at your own report and understand how the CIBIL score is given, right? So my maximum score is 900, and it typically starts with 300. And what does it mean, right? So what factors affect this your payment history? How much credit are you taking? Are you making multiple inquiries with various banks for taking credit? Right? So that will downgrade your credit rating. And then what kind of a credit mix you have, right? Vehicle loans, home loans, etc. And those kind of things are explained very well over here. So do look at this to understand this business and how it impacts you, particularly as an individual more. So that's about the external credit rating. Now let's look at the internal credit rating process, right? So as I mentioned, banks being in the entire business is giving credit, so they cannot just rely on the external credit rating agencies. For example, even if let's say banks want to invest in a commercial paper or they want to invest in, let's say, a bond, right? Banks or other financial institutions also, they will not just rely upon external credit. They'll do their own assessment as well on top of that, and they will give some weightage to the rating given by the external credit agency. They also followed some methodology, looked at some data, maybe spoken to the management in order to arrive at that rating. So banks are now each bank may have their particular factors that they look at, and they may give different weightages to those factors. For example, somebody may give a lot of weightage to the industry in which the company is, right? Maybe they will give 30% weightage. They will give, let's say, 30% weightage to let's say the promoter's track record, right? Just as an example, some bank may give 25% weightage here. But the basic thought and process behind the rating approach, methodology, getting etc. is similar, right? So because there are certain X factors that you will typically look at, and the bank's policy will very clearly mention what is the rating methodology they follow, what factors they take into account, and the bank's forms that you typically fill in, they capture the data in that fashion so the bank can very easily assign a rating to you. And they have a rating scale in which they will fit you. Maybe they have a 10-point rating scale. They will say, this is the best customer, the best rating. So that is 1, and then maybe moving down to 10 worst customer that bank will never touch. And then they test their rating system from time to time. So let's say they have given a rating to a customer now 2 years back, they has taken a loan. If they find that we are giving 2 ratings to specific type of customers, but they are failing, they should be given 3 rating, right? Then they go back and change those criteria. Also, you can't have a rating scale continuing exactly the same way, same weightages all throughout the life, right? So based on experience, banks have to change that. How internal ratings are used? Credit selection, right? Who to give credit to? How much exposure to take? Should you, give, for example, 10 crores loans that somebody has asked for, should you give 10 crore, 8 crore, right? Can you comfortably sort of, give 10 crores, right? Tenure and price, how many years to give? Should it be 7 years, 5 years, right? And what price, right? How much interest to charge? How frequently to monitor that account? How frequently to ask for, let's say, stock statement? chartered accountant certifications, right? How to frequently to go and inspect the company, right? So those kind of things are decided. And intensity, how much intensity, what kind of reports you ask, what kind of certifications you ask, what kind of inspection you conduct. You go and only talk to the key people at the head office, or you go and visit the branches, plants, right? Those kind of things you have to decide based on the rating. And then analyze the migration of deteriorating credit. If you know the entire in their entire portfolio is something called the migration can happen. The companies at rating 4 might in, let's say, in COVID scenario, right? For example, COVID was bad time for a lot of businesses, except few, right? Those which were in the business of sort of providing medicines for COVID, etc. They did well, but other than that, a lot of businesses suffered. So there was a migration in the portfolio. Those which are at rating 4 could have migrated to rating 5 because of the bad business conditions. So that they have to monitor and decide the level of approving authority. So, for example, let's say below 1 crore loan, excellent rating, 2 rating out of 1 to 10. Yeah, I think maybe at a certain level people can approve. But otherwise, if the rating is low, even up to 1 crore, then it may go to a higher authority for approval. So, those are the ways in which banks basically use their internal ratings. This is one of the simplest, models, EIIF model, which has broadly 4 criteria for, and then the weightages for coming up with the rating. This is just an example. Each bank has its own methodology. They call it something different, right? So, SBI, for example, will have its own methodology. Punjab National Bank will have its own methodology. Let's say, Axis Bank will have its own methodology. But broadly, these are the criteria that they look for. So, let's look at those criteria and how they assign the rating. For example, here in this EIIF methodology, the banks are having 4 broad criteria under which they are assessing: external risk factors, industry specific risk factors. For example, external could be anything in the economy, global risk factors that are relevant for this particular company, right? How the company might get impacted. Industry risk factors, let's say this company is in hospitality industry, for example, which heavily suffered in the initial phases of COVID, right? Or maybe airlines, right? So banks. So that is an industry specific risk factor. Then internal risk factors very specific to the business of the company, right? The way the way they conduct business, their management, for example, the kind of suppliers they have, the kind of customers they have, customer concentration, so on and so forth, right? And then there are financial risk factors, based on their liquidity position, the ratio analysis, right? Those kind of things. Here in this example, I have put 25 equal weightage for all these factors. Not necessary. Some bank may give 35 rating for, let's say, internal risk factors, 15 for financial risk factors, and something else, right? So that's based on the bank's experience over a period of time. Now, then based on these factors, let's say this is a 100-point scale. Then depending on the scale that a particular borrower gets, they will put on, let's say this is a 20-point scale, right? Banks may not have 20 points, but let's say somebody who's, let's say, having a score of 65 to 69, 70, right? They will be here in this satisfactory scale, right? So 10. And then over 70, but up to 74, they will be in the grade 9. So here in this scale, 1 is the best and 10 is the worst. 10 is lost, right? And 1 is very, very low level of risk. So like that, bank based on the score that, so under each of these, under external, internal, there will be a lot of questions, and then based on the answers to those questions, etc., those will be summarized and then the score will be assigned for that specific criteria, right? External, internal, etc. And then that total score will be summed up, and then accordingly, you will put that particular borrower or particular applicant into a specific sort of at a specific rating grade, right? So that's what we'll do. This is an example. So there's a PQRN company. So they scored 20, 21, 23, and 24 in this EIIF factor, right? So their total score is 87. So, so this is between 84 to 88. So they are getting a risk grade of 5 in this particular scale. So 87 will come somewhere this greater than 84 and up to 87, right? So 87 will come here, and then they'll get a grade of 5 in this particular example, which is a low moderate risk, right? So just tad little bit lower than the low risk that they could have got if they were 88 or if they were above 88, right? So that's what it is. Just an example here, but fundamentally it will explain how this rating methodology works, right? And each bank will have its own rating methodology in place. Now, after that, what the banks do, and I think it is not here in this example again, I think I have explained the same scale over here, but they additionally have something called probability of default or PD, right? So, for example, probability of default for 20, a loss case is 100%, right? It's already loss case. And then maybe probability of default in very low risk is, let's say, 0.8%, right? So only 0.8% of borrowers in very low risk are likely to default in making payments, right? So it's likely to be a bad risk that the bank has taken. Maybe at grade 2, it goes to, let's say, 0.95, right? So 0.95%. Low risk, let's say grade 3 is 1.2%, right? So based on the experience, the bank, says probability of default in this particular case is X percent. If the bank is new, they take, help of rating agencies like CRISIL, etc., and of course, the bankers who start that bank will be experienced bankers, but still the bank is new, right? So they don't have their own data to rely upon for constructing this scale. So they'll take help of CRISIL, etc., for building that particular scale, correct? Because they don't have the past data. They can't, say, for example, in this credit risk grade 1, so many people, so many borrowers are likely to fail. So they rely upon CRISIL, etc., to give this kind of data to them. So now that's specifically about, having a particular methodology and, assigning the grades and assigning the probability of default for those particular grades. So that's how, fundamentally the external and internal credit ratings work, right? So what we looked at in this particular video, right? A few things. So what basically credit ratings is, credit ratings are, how we bifurcate them broadly into external and internal, who conduct the external rating, like, these global rating agencies and Indian rating agencies. And in internal, how the methodology a particular bank or financial institution can choose to have their own methodology. We looked at, which are the rating agencies in India, and some of them are the subsidiaries of the global rating agencies. And why you need to conduct internal rating in addition to the external rating, right? For example, banks are in the business of giving credit itself. It's the biggest risk that is there in the banks, apart from interest rate risk. So, they have to, look at their own internal rating mechanism as well, because there are certain inherent defects in the external ratings. For example, there is a conflict of interest. Then we looked at CRISIL and CIBIL. Just go through their website. I'll again urge you, please spend some time there to understand that how they basically assign ratings, what are the different kind of ratings they give, right? And please download your own CIBIL report as well. You get it for free once in a year. Then how internal ratings are conducted, right? And then what are the uses of internal ratings that we looked at? And then we just looked at one simple, textbook kind of a model on, how we can use some of the criteria to assign come up with a score for a particular borrower, right, based on information that is given to you. And then, of course, your own due diligence also. And then, you can put them on a particular credit rating grade in that particular scale that the bank uses. We took 1 to 20 as an example. And then based on the past experience, or based on, let's say, input from rating agencies, etc., banks can, say this is the likely probability of default in this particular case, right? So, and then depending on the PD, banks take a decision, how much interest to charge, whether to give the loan, whether to insist on a collateral, right? Those kind of decisions banks take, right? So that's broadly about, about the credit, rating that takes place in the business environment and also for the individual customer, right? So thank you very much for your patient listening in this to this video, and all the best. Thank you.